I've built an ETF backtesting model which looks at selecting the ETF that has the highest growth rate in the prior month. You then hold that one and switch between, in this example, 4 ETFs to try to maximize performance. First of all, we select the time period we want the study to start, and here in the US date format, this is the 1st of June 2007, and then what I've used is a workday formula to pick up the first Monday of each month, and then I've used a Google Finance command that says if the Monday is a bank holiday, then choose the Tuesday, which is the +1 here. So this makes sure that I automatically pick up all the right dates just from putting in some numbers here, just adding 30 or 31 days onto my initial start period, and then that's automatically populating the dates. Then I've selected some ETFs. These are all US ETFs. First one, S&P 500, then a mid-cap growth, small-cap growth, and then finally the NASDAQ. So prices are calculated, the monthly growth is calculated, and then it's ranked. So we've got NASDAQ here ranking number 1 for a little while. Now we come to our trades page. So this is saying if it's ranked number 1, then buy it. And then this is quite a complicated formula, but just looking at all the different buy, sell, and hold calculations. So here it was number 1, now it's not, so it says sell. This is number 1, so it says buy the S&P 500. And then what we do is we start out with an existing fund, 10,000 in this case. Then it works out, well, how many shares in the ETF can I buy for 10,000? Buys them. We've got income, which is sales, and then portfolio, which is if you're just holding the ETF. So here we're holding it and the value's going up. And then opening cash. So that 14 is just the 10,000 less 9986, which was what we spent. So we've got a trading cost round trip. So there, what we've done is just try to work out how much it would cost to put on a buy, sell, and a sell trade. So in this case, it's $10, which might be a bit too low. It also doesn't allow for differences between the bid and the offer price. So any spread isn't taken into account at the moment, but you can increase this number here if you want to capture the bid offer spread a bit more. Yes, we've got all our trades, and then this is just tracking the money as we go through time. So we've got the 2008 downturn, we go right down to 5,600, so we've nearly halved our trading capital, and then eventually it starts coming up. 15, 16, 17. Now we look at the summary. So what this is saying is that if we did nothing, just happened to buy, this is the NASDAQ, we would have got 41,000 back as our return, but using the model, we've actually only done 22,000, and we did 108 buy trades, and that's out of 149 months. So pretty much every month, maybe about 2/3 of the time, we were buying and selling. And the maximum holding period was 5 months for the NASDAQ, 5 months for this growth one, 3 months for the S&P 500. So we weren't really holding for very long. There's a lot of trading, a lot of switching out. So if we just done a simple buy and hold on S&P 500, we would have made nearly 20,000. So slightly less than the model, but these other two small cap and mid cap growth ETFs, they would have outperformed the model, and we wouldn't have had the time and the hassle of trading in and out. So this model, you can then change it and you can say, okay, well, actually, I want to do maybe something else. Actually, let's look at Korea, put that in the mix, because these are all quite heavily correlated because they're all US funds. Right, okay, so yes, it's all calculated through. I'll put it to the summary, and oh dear. So quite a drop off in the model there. So the Korea ETF would not perform very well, although we do seem to hold it for a lot of the time. So that's interesting. And then, yeah, very poor returns on the model. So the idea is that you can just change the ETFs, look at the performance, and then you can also alter the costs of trading if you want to penalize yourself more for how much trading is costing you. Any feedback is most welcome.